Good afternoon, everyone. We're going to get started here in just about 30 seconds. We'll give time for those who might be signing on a little bit late to be able to hear the entire presentation. So give us about 25 seconds and we'll be getting underway. All righty, we're going to kick her off. I'm Dave Duncan, the CEO and Chairman of Duncan Financial Group. I want to first thank everybody for taking the time to be part of our presentation today. We're looking at about a 45-minute long presentation that's going to focus on your 401k or other qualified retirement plan, how it's affected by the COVID virus. What I would say is that although this presentation is focused on 401ks, you are probably aware we also do property and casualty insurance for businesses. We do group health and human resources services for businesses, and we do tax and accounting services for business. And we've had seminars about those various subjects over the last couple of weeks, and we are going to have one coming up tomorrow at 2 o'clock on the group health and HR implications of the coronavirus. So on your initial invitation that you received to be part of these meetings, you have the ability to sign up for that if you have not already done so. If you've already done so, you are fine. I want to make sure everybody stays safe and follows all of the guidelines of the CDC and our Governor Wolf, and make sure that we stop the spread of this virus as rapidly as possible. I wanted to give you a quick update on where we are at Duncan Financial Group related to our operations. We are doing business as unusual. We have about 108 employees, 8 to 10 of which are in the office at any moment in time, and the other 95 to 100 are all working remotely. And we are at full strength. Any questions, issues that you may have, we are fully staffed to be able to help you. It's truly business as usual in unusual times. A couple of housekeeping items. Number one, I want you to know that you can ask questions electronically through the Zoom portal. We'll be able to see them, and we are going to have a question and answer period at the end. You can put your questions in, though, at any time. We are also going to send a copy of this deck of all the slides to all the attendees when we're done, and there will also be a recording of this webinar that will be available on our website, duncangrp.com. So let's get right into it. I'm going to turn the agenda and the control over to Brian Duncan, who's going to get us started. Thanks again, everyone.
Thanks, Dad, and thanks everyone for joining us here today. I'm Brian Duncan, president of Duncan Financial Group. I'd like to echo Dad's comments. So we thank all of you for continuing to work with us here through these trying times. And what I think you'll hear from our team today is that in so many ways, we are here for you, we're here for your participants, and we're here to help. We feel it's very important that we're communicating with you regularly, and that the questions that you have or the answers that you need, we are here to help and deliver. I'd like to highlight some of the topics that we're going to go into further detail on as we work with the rest of our team here today in their individual presentations. A number of items you may think about here and decisions you're making as it relates to your retirement plan in the COVID-19 world. One thing I think it's important to start off with as you think about managing a successful retirement plan in the COVID-19 world. In many ways, it's the same as running a successful retirement plan when it's business as usual. We're going to talk today about some very, at times, fundamental, time-tested truths of whether it's investing or helping participants or helping you manage your plan. We feel like it's important to keep that long-term perspective, but at the same time, make sure we're reacting to and aware of what's available now. So Nancy Connors and Tim Kunkel are going to talk more about the CARES Act and some of the opportunities that creates for you within your plan. As a plan sponsor, it's important that you know that some record keepers out there are creating an opt-in approach to some of these changes. Some are taking an opt-out approach. This will change if you opt in or opt out, depending on your record keeper. Some plan distribution opportunities for your participants, in addition to required minimum distribution changes that are out there. It's also important to keep in mind that these will be plan amendments. Nancy will talk more about that as she highlights that section. In addition to that, we're going to talk about keeping a long-term investor perspective, especially for participants out there, that their 401k or their retirement plan balance is a crucial element of their long-term retirement income plan. Keeping a long-term perspective, we feel, is more important than ever. In addition to that, we would highlight relying upon the experts you've hired. Your plan administrator, we as a plan administration team, Barb Gongloff and her team, have been communicating with plan sponsors regarding the CARES Act and considerations and decisions. But in addition to that, working directly with participants who have questions about the situation and the distribution opportunities available. We're here to help. And then alongside of that, our advisor team that you're going to hear from today, we're here to help you and your participants understand the opportunities and make decisions accordingly. And then lastly, Alex Klein will talk to us more about financial wellness and how that can drive successful outcomes. I just wanted to highlight, before we jump into the CARES Act, some perspective as it relates to financial wellness. Mass Mutual did a financial wellness study they released at the end of 2019 of over 863 plan sponsors. And there were a number of takeaways that probably aren't too surprising for us in some ways, but in other ways, it really helps us understand what do our participants need from us and what can we be doing to help them as it relates to their retirement plan and their broader planning. So you can see here, 8 in 10 plan sponsors believe their employees are having some issues financially, that they also may need the plan sponsor to help provide them with the resources to make educated financial decisions for them. So while this isn't an in-depth presentation on financial wellness, I also wanted to share here too, just some perspective on when we surveyed the retirement plan sponsors, what were their concerns for participants in the plan. You can see there highly ranking is financial readiness for retirement, employees or participants being prepared for medical costs in retirement, and then of course, participation in the company's retirement plan. And as we go through this presentation, we're also going to share with you some case studies, real world examples of the power of collaborating with the advisory team at our firm, the administration team, and you as a plan sponsor to really help your plan and plan participants. And I think it's important to highlight these concerns and some of these ultimate anxieties were out there in December of 2019. Imagine now what employees and participants are thinking in the current state that we're at, the turbulent, difficult times that we find ourselves in. They need our help, more than ever, and we're here to help you make those decisions and ultimately help them be on the right track. So with that, we'll start with the CARES Act overview, and I'm going to turn it over to Tim Kunkel from our retirement plan advisor team.
Okay, well, thank you, Brian, and thank you, everyone, for taking a little bit of time out of your day to join us during these challenging times. What Nancy Connors and I are going to do next is give you an overview of the CARES Act and from a retirement plan perspective. So it was a large act that was put into place on March 27th of this year called the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act. And what it really did from a retirement plan perspective was introduce a few optional provisions that plan sponsors can now consider adding to their retirement plans to offer some relief to employees and really loosen up access to retirement funds for folks that have been directly impacted by the coronavirus. So I talked about retirement plans on 3 main topics, as Brian kind of mentioned. The new in-service distribution called a coronavirus-related distribution, or CRD. I'd also addressed plan loans, that would be existing loans or new loans initiated during the time frame, and also the suspension of the required minimum distribution rules for 2020. So we will now go into a little more detail in each one of those, and I'll start off with the coronavirus-related distribution, or the CRD. So as we mentioned, this does introduce a new type of in-service distribution, which is an optional addition for your plan. And one thing that this does not do, it does not replace or amend any current in-service distribution options your plan may have in place today. So if you offer say an age 59 and a half early withdrawal option or a hardship withdrawal option in your plan today, the CARES Act does not change any of those provisions or qualifications to apply for those. But what it does do is introduce a new type of in-service distribution, which has some different rules associated with it. Most namely, the 10% early withdrawal penalty that would typically apply to a withdrawal under age 59 and a half has been waived for the CRD. And the 20% mandatory tax withholding also does not apply to the CRD. Now, it is still a taxable distribution. However, the taxation has been loosened a little bit to allow an employee that would take a CRD up to 3 years to pay those taxes. And also, so that what that would do for them is allow them to get the most money that they need right now and worry about the taxes later. So waiving that 10% early penalty and letting them decide when they want to take their taxes. The other thing that it allows you to do is also say the employee comes back to work in 2 or 3 months and doesn't need all that money that they might have taken out in a CRD. The CARES Act allows them to repay that distribution that they took out, again, over a 3-year period. They have to make up that distribution. So it would not be treated as a taxable distribution for them at that point. And that would be handled just like a rollover contribution. So that money would be able to be placed back into their retirement plan. And again, no tax liability for them then. So now the distribution must come from an eligible retirement plan. And what would that include? Well, that would be an IRA or an individual retirement account, a 401A plan, which would include a 401k plan, 403B, or a governmental 457B plan. So a couple of plan types that it does not apply to would be a defined benefit plan or a money purchase pension plan. But the other types are able to add the CRD as an optional provision immediately. And if someone is going to apply for a CRD, it's going to have to be within this calendar year, anytime after January 1st of 2020 through December 31st of this year. And they did backdate that to January 1st, just in case somebody might have had a coronavirus-related issue that preceded the passing of the CARES Act. So it's going to offer them some relief back to January 1st if they did have that issue. Now, the CRD is limited to a maximum aggregated amount of $100,000 across all of an individual's retirement plan accounts. And again, that would include any IRAs that they have. That might be a 401k in your plan or some prior employer plans they may still have outstanding. That is not a limit that the plan sponsor has to monitor. That is something that the individual has to monitor to make sure that they do not exceed that $100,000 limit. Now, to be eligible to take a CRD, there are some eligibility criteria, and the individual or their spouse or their dependent has to be diagnosed with the coronavirus, or the individual has to experience an adverse financial consequences due to the virus, whether that be in the form of being quarantined, laid off, or furloughed, or having their work hours reduced, or even if their business closes, or unable to work due to lack of childcare availability, or any other factors as determined by the Secretary of the Treasury. So they did leave that a little bit open-ended for some further interpretation as the virus and the containment continues to evolve. Now, a participant that applies for a CRD, they are required to self-certify their eligibility for the CRD. And what that does for a plan sponsor is it takes that responsibility off of you, and you are able to rely on your employees that apply for a CRD to self-certify their eligibility. So again, take a little bit of responsibility off of the plan sponsor's plate. So next, that's the summary of the CRD, and now I will talk a little bit about the loan provisions, the loan relief. And the CARES Act does offer loan relief for new loans initiated as well as outstanding loans. So as far as new loans being initiated, any individual that meets the eligibility criteria, and this is the same criteria that we just talked about for the CRDs, they're able to take out a loan during the 180-day period after the enactment of the CARES Act. So again, that was March 27th up through September 23rd of this year. They're able to take the lesser of $100,000 and 100% of their vested account balance. And you can see those limits are much higher than the standard loan limits of $50,000 and 50% of the vested account balance for a non-coronavirus related loan. So it does, again, extend some extra relief to folks that may need and would qualify. Now, for existing loan repayments, this might be helpful if your business has had some layoffs or if you've had to furlough some employees, have some people that are not currently working and they may have outstanding loans. What the CARES Act allows them to do is they don't have to stress about those loans being defaulted or being treated as a taxable distribution because they can't currently repay them because they're not receiving a paycheck and their payroll deductions aren't being applied to their loans. So what the CARES Act allows plans to do is extend and delay the due date for those repayments for an eligible individual for up to a year. So, and also when they do come back to work, there are a couple different options, which again, working with our plan administration team, who has been working very closely with all the different record keepers and vendors to know exactly how that would impact on their platforms and for your plan, exactly what the options are. But the extension of the loan period for up to an additional year, or they may be able to re-amortize their loan once they do come back to work, keep the original terms of the loan, just add in any missed payments and interest that may have accrued during that time. So again, a couple different options, which our team is very familiar with, and we'll be working with you as you decide to add these provisions to your plan. So that's the summary of the loan relief, and I will now turn it over to Nancy Connors, who will take it through the rest of the CARES Act.
Okay, thank you very much, Tim. Tim did cover the CRDs and the loan benefits that you can add to your plan. Those are options for your participants to go ahead and take money out of the plan. I'm going to cover the waiver of the required minimum distributions, which is actually allowing you to keep money in the plan and within your IRAs. All required minimum distributions have been suspended for 2020. It also does suspend anybody who had turned 70 and a half in 2019 and had elected to delay their first required minimum distribution to the year of 2020. That can also be waived, is also waived at this time. If you are in need of the required minimum distribution and you still want to take the required minimum distribution out of your IRA or your 401k, that can be done. But it is not required. And one thing to keep in mind as well is that at the end of last year, in December of 2019, the Secure Act was passed, which actually did change the age for the required minimum distribution. Anybody who was 70 and a half in the year of 2019, they did have to start taking their required minimum distributions. But as of December of last year, that age has now turned to 72. So anybody that is turning 72 in 2020, you do not have to take your required minimum distribution. That goes across whether it's a 401k plan, a 403b, a government 457 plan, or an IRA. And as Tim was saying, also the CRDs and the loan limitations are optional to your plan. And Brian, if you can go to the next slide for me, please. Thank you. The timing, if you do decide to allow to have those CRDs within your plan, as well as the additional loan limitations, it does require that your plan document be amended. Now, you can start the CRDs right away, immediately, and you can do the increased loan limits right away. And you have until the end of the plan year, beginning in 2022, to actually put those amendments into your plan document. That's for non-governmental plans. You have until the end of 2022. If you have a governmental plan, then you actually have until the end of 2024 to go ahead and do those amendments to your plan. As Brian and Tim had mentioned, the plan provisions that we're talking about here are optional. You have the option to allow for these CRDs and the increased loan limits within your plan, or you can opt out of it. Different record keepers are differing very drastically as far as how they are implementing these plan provisions. Some of them have an opt out where it is automatically added to your plan and you have to opt out of it, or other record keepers need you to contact them and actually opt in. You can adopt the plan provisions separately. You can choose to do the CRDs but not do the increased loan limits, or vice versa. So everything is depends very heavily on the record keeper where your funds are held for your 401k plan or your retirement plan. If you have not heard from your record keeper or your plan administrator as of yet, or your advisor, then you definitely need to reach out and clarify what type of whether it's an opt-in or an opt-out for your plan sponsor or for your vendor. Another thing is that many of the record keepers, excuse me, many of the record keepers are also waiving their processing fees for these CRD related distributions. And from there, I will go ahead and hand it over to Rob, who's going to talk about what things that we're talking about with plan participants.
Thank you, Nancy. Just wanted to kind of go over a couple of different things. With the market, the way it's been going lately, it's been very volatile. As of March 12th, the S&P 500 index entered into bear market territory, which we haven't had for about 10 years or so. And it's defined as a 20% decline in the index's past high. We've actually had a little bit more of a decline than the 20% as well. But most of the time that we talk to our employees, talk to plan participants, talk to plan sponsors, we want to just continue to focus on the long-term patience that we need as we go. There's downside volatility, but there's also upside volatility. And time in the market is more important than trying to time the market. Now, I'll go over that in a second. Long-term investors, research has shown it's generally not wise to try to time the markets in times of uncertainty because it's really difficult to be correct twice. You have to be correct whenever it's time when the market's going down, but you also have to time the market and get in before the market goes back up. One other thing that we do try to mention is when the market's bad, sometimes it's a really good time to increase the salary deferral because it really does a good job of buying shares that are on sale. I'll talk a little bit about dollar cost averaging in a minute as well. So in the next slide really talks about timing the market. And my point before was time in the market has definitely proven better than trying to time the stock market. If you take a look at the chart right there, it basically says over a 20-year period from 1995 through 2015, if you miss just the 10 best days in the market upturns, you would have significantly changed your overall long-term rate of return. So if you take a look, a fully invested portfolio with $10,000 back in 1995 would have grown through all the ups and downs up to about $48,000 and some change. If you would have just missed the 10 best days in that time frame, your account would have gone from 10,000 to only about 24,000. So we really want to make sure that people stay in the market when it's hard to stay in the market. That's part of our job, is to make sure we have these conversations with the plan sponsors as well as the plan participants. Timing the market is very hard. And the people who do stay involved, do stay invested whenever it's hard to do so, are often very rewarded in the time right after a downturn in the market. And take a look at this slide, the 5 biggest market declines and subsequent 5-year periods from 1929 through the year 2019. Basically what this has done is it shows you that the market decline back in the crash of 1929 through the year 1932, there was an 86% drop in the market, but all you had to do was be patient and most of that was returned. As a matter of fact, your average rate of return for the 5 years after each one of these drops in the market has been 23.15% return per year. That's the average. So when there's a down market, when there's a down turn in the market of over 30% or more, typically there's a really nice snapback over the next 5 years, and the average is 23.15. The absolute worst you did in the 5 years after a downturn in the market was 17.39 or 17.15. So about 17% per year after the market downturn. So again, it's very important that we let everybody know it's a really good idea to just be patient with the market, be patient, and don't try to get out of the market. One of the things that I mentioned so far in this downturn, the one that we're in right now, the market's been down, but if you would have missed out on 3 days so far, March 24th, 25th, and 26th, if you missed those 3 days, if you were out of the market, you panicked and got out of the market because of the coronavirus, those 3 days you missed out on about 21% rate of return as a recovery for what the market's been doing. So it's really important to do that. This next chart is the dollar cost averaging. I'm not going to spend too much time on this, but I just want to kind of look at the second column there, the price per share. And it's very similar to, not exactly the dates are correct, but pretty similar to what has happened with the market over the last 2.5 months or so. Market was very nice in January. So, you put $1,000 in at $20 per share, you got 50 shares. Well, the beginning of February or late February, early March, the market went down to $15 a share. That same $1,000 bought 66 shares. And March was a really bad month. The market went down even further. $1,000 at $10 per share got 100 shares. So in general, if you just take those 4 dates, the average cost per share was $15.75. But because the dollar cost averaging, that money's going in on a monthly basis without regard to what the price is, you actually averaged your average price per share is 14.69. So what I tell people all the time is you're putting more dollars in, or you're putting the same amount of dollars in. As the money grows or as the market returns in value, you have more shares to go back up in value with it. So what I want to do next is I want to transfer this over to Alex Klein from our team, and he's going to talk about financial wellness.
Hello, everybody. I want to take a few minutes and talk a little bit about the keys to an effective financial wellness program. Financial wellness is a topic receiving a great amount of attention in recent years, but many plan sponsors are unaware of what that really means for their employees. Financial wellness is vital to ensuring that employees, they need to feel secure about their financial well-being. It can help meeting current, future, and ongoing financial obligations, and understand the benefits of maximizing participation in the company's retirement plan. Financial wellness is a little bit more than just the retirement plan. In fact, it's a lot more than the retirement plan. Some of the things that a good financial wellness plan will cover, and Brian covered a few of those in some of his slides, but retirement income planning, retirement account advice and analysis, personal income tax planning, Social Security and Medicare, elder care and estate planning strategies, cash flow, budgeting, debt and credit analysis, personal insurance, identity theft, education funding. All those topics need to be included in the good financial wellness program. And we have Duncan Financial Group, we have a team of financial professionals here to help you with all those various topics. So when you look here at this, on this slide, the benefits of an effective program, in 2018 Workplace Benefits Report by Bank of America Merrill Lynch, it found that 91% of employees participating in financial wellness programs they found them effective. 95% of employers offering such programs found them effective in meeting company goals. And you saw some of Brian's statistics, but let me just give you a few others from that study itself. Only 31% of employees are participating in financial wellness programs. 2 in 5, or 38% of employees, feel less than financially well. And that's all about those different topics that I talked about. Again, cash flow, budgeting, credit cards. There's a lot of different things that are causing stress for individuals today. There's a disconnect between employers and employees on what matters most to support financial wellness. Employees agree that the number one most helpful resource in improving financial wellness is advice from a professional. And only 7% of employees identified healthcare as an important building block of financial wellness. So now I'm going to talk about, if you go to the next slide, Brian, I'm going to talk about some of the key factors to an effective financial wellness program. First, it needs to be personalized. I'm going to give you some of the definitions of the way of how we describe what you see on your screen. It's important to understand that every employee's needs and goals for financial wellness are the same. We all know younger employees have very different needs than older employees. Younger employees are focused on paying off debt, mortgage, buying a house, raising a family, whereas older individuals, we're focused on, retirement and having a secure retirement plan and the cost of funding health insurance in retirement, as Brian showed you on one of his slides. So it has to be personalized. And emphasized, when should an employee begin planning for retirement? Well, of course, as soon as possible. Many employees do not fully comprehend the benefits of contributing to a retirement plan. They view a retirement plan as just a savings plan. The power of compounding is lost when individuals wait until they feel financially secure, a point which may never come, resulting in lost time and added stress. Now, we think a financial wellness program needs to be inspiring. Most plan sponsors think that wellness programs mean just educating employees, but we think it's more than that. However, it's more than financial education. It's inspiring them to take action and helping them create habits so it's consistent to achieving their goals. The Workplace Benefits Report found that there are many barriers keeping employees from improving their financial well-being, and those are identifying their financial goals, not knowing who can help them, not understanding how, where to start, or what to do. And a lot of individuals, when it comes to financials, they're afraid of making a mistake. And they think of finances as they're uncomfortable with it. They're uncomfortable with talking about the financials. When those issues are addressed by professionals like we have at Duncan Financial Group, we believe we're creating a much better outcome for your employees. We think a financial wellness program has to be actionable. Your program should provide employees with information needed to make the proper decisions or where they are financially. There are a few ways to provide the support, including on-site or off-site seminars, one-on-one personal assessments, and online or virtual education, just like we're doing right now. It's vital to offer different ways to provide support. Okay. And then ongoing. We obviously think it has to be ongoing. Okay. Financial planning, retirement planning, financial wellness, it's not a one-time deal. It has to be ongoing for people in their 30s, then to their 40s, then to their 50s, 60s as they get prepared for retirement, okay? So we believe that a good financial wellness program needs to be ongoing, all right? So I'm gonna give you a little case study on this. So one of the programs that we did, we got hired by an employer, and they asked us to get in and build a financial wellness program. When we started this plan, there were 19 employees in the 457 plan. Within 6 months, and thanks to my team, with Tim Kunkel, Ronnie Kims, and Don Waite, we did a series of workshops, one-on-one meetings. We attended their open house in a number of different locations. And within that 6-month period, we increased our participation to 47. Okay? But it wasn't just about the retirement plan. We helped them understand when someone says to us, hey, I don't have the money to put money into the retirement plan. Well, then what we're doing from there, we're saying, okay, why not? So we're going to open up the hood and figure out why. So we're going to look at your financial statement. We're going to look at your credit cards. We're going to look at and try to create a budget for you to help you free up money so that you can put money into your retirement plan. So for those of you that are interested in looking and maybe possibly putting together a financial wellness program, reach out to me. I'll introduce you to our financial wellness coordinator, Don Waite, and have him reach out to you. But as we go forward financial wellness is going to be an extremely important thing for your employees. And thank you. With that, I'm going to send it back to our CEO and Dave Duncan.
Thanks, Alex. Appreciate that. Great job. I also wanted to add a case study to this presentation that I think really brings out the value in working with an organization that provides competent, good financial advice to your participants. Rob McCalmont and I worked on this together a few years ago. And what we were looking to do was take over the retirement plan of a bus company out in the Philadelphia market. And that bus company's retirement plan provided much the same investment performance that our retirement plan did in terms of what their mutual funds gained. I was reviewing that and I looked at, for example, their small cap fund did something like 56, 57% return this one year, whereas our small cap fund only did 46%. So you'd kind of chalk that up to a win for the other side. I began looking at all the other funds, the large growth funds, the large value funds, the international funds, and I found pretty much the same conclusion, is that the mutual funds within our program and the mutual funds within their existing program provided pretty much the same returns. Some we were a little better, some they were a little better, but it was fundamentally the same performance. What I did look at, though, was how much money was in the small cap value fund at the other vendor. And in a plan that had over $9 million in it, they had $15,000, all of $15,000 in the small cap value fund. So it was great that that fund went up 50+%, but $15,000 is all that benefited from it in a $9 million plan. I looked at our small cap value fund, and just happened to be a coincidence that we have a car dealership client right up the street, literally right up the street in Philadelphia from this bus company. And in a $6 million plan, in that automobile dealer plan, $6 million plan, we had almost $500,000 was in the small cap value fund. So in a smaller plan, we had much, much better allocation to that particular asset class that did the very best. And so what I did, Rob and I put our heads together, we looked at the bus company's existing plan as a whole. If you added up all the participant accounts, how did this particular plan do the previous year? And we found that their plan, as viewed as one account, was up a little bit better than 9%. The car dealer that was our client, same performance, roughly from all the funds, they were up 24%. And the reason for that was that there was a strong recovery in the equity market that year from a time that people were worried and concerned about the market. And what happened was Rob McCalmont and his team were at this car dealership, our client, every 6 months, reminding people to keep putting money into stocks, don't quit investing in equities, stay the course, long-term, this will be the best for you. And when that market recovered, they benefited handsomely. The bus company's advisor, I believe, was curled up in the fetal position under his desk, sucking his thumb. He didn't go see the participants, because that's tough to go see people when the market's down 20, 25, 30%. He didn't do it. So left to their own devices, the participants in the bus company plan stopped contributing. They moved money from equities to bonds or the fixed income or the fixed bucket. And as a result of that misbehavior, when the market snapped back strongly, they got a 9% return instead of a 24% return. To me, that's the best example why you want to take a long-term view and why you want to work with a firm that gives you good, competent, sound, consistent financial advice. I got to believe we're in a circumstance like that today where the markets are going to recover. They're going to recover at a time nobody expects them to. And if you stay patient, you stay allocated to equities, you're going to do very, very well. So with that, I'd like to begin the Q&A session. The question is, what is your expectancy on recovery of a small cap value fund? That's a great question, because depending on how you want to measure the market, it's down somewhere between 10 to 15% year to date here in the United States in the large cap area. However, if you look at small cap value, it's down almost 40%. So clearly small caps have dropped substantially more than the market as a whole. However, if you measure over long periods of time, 15 years, 20 years and longer, the category of small cap value has actually done better than any other type: large cap, mid cap, growth, value. Small cap value has been the #1 performing category over long periods of time. So it's hard to say when the recovery will happen. I'm certain that it will happen, but I do think that now would be a good time to consider rebalancing your portfolio. And whatever percentage of your portfolio you had in small cap value as of the end of last year, I would rebalance your portfolio to get you that same percentage of your account in small cap value today. You'll be selling other investments that have done relatively better, and you'll be buying more of an investment small cap value that has done poorly. That's the importance, in my view, of rebalancing your portfolio. Another question coming in, and I would direct this one to Nancy. The question basically is that you mentioned about the RMDs being suspended this year. Is there anything that someone can do who's already taken an RMD? Is there any way for them to undo that, so to speak?
Yes, actually there is. If anybody that has already taken their required minimum distribution this year in 2020, if you're still within 60 days of that withdrawal, you can absolutely go ahead and roll it back into the IRA or the 401k plan that it came from. We're still awaiting some additional guidance from the IRS, but this could also be extended to anybody that took distributions, required minimum distributions back in January or February as well.
Gotcha. Thank you.
Mm-hmm.
Next question I'm going to throw over to Tim Kunkel. Tim, you mentioned about people being able to get a $100,000 loan from their plan as well as a $100,000 distribution. The question is, can they get them both?
If the plan allows, the plan is able to add both the loan option and the CRD option. So if they were to have enough money in their account to do both of those things, and the plan decided to add both, then.
Got it. The last question that I have at the moment, I'll throw over to Alex. And Alex, can someone engage the financial wellness program at Duncan Financial Group without already having a 401k plan here?
Sure, that is yes, Dave. We have a number of clients that we have a financial wellness program in place. We provide the services that I talked about relative to education and cash flow budgeting, tax planning. The answer to that is yes. We have a number of clients we already do that for.
I'll make one last call for any questions. And seeing none, I will close this up here. I want to thank everybody for taking the time to be part of this today. I also want to make sure that we acknowledge many of the people on this webcast are clients of ours. And we want to thank you for your business and your continued business. The key is we're here to help you, whether you're a client of ours now or not. We're here to help you with whatever your needs may be relating to 401k and retirement plans. I'm extraordinarily proud of the team that we've built here to help you with your retirement plans. And also, I should mention that we have the TPA side of the arrangement too, led by Barb Gongloff. Barb and her team, unfortunately, none of those are on the webinar today, but they have great capabilities to help you design and implement and maintain a wonderful retirement plan. The crew you just heard is awesome at helping you and your employees make good long-term investment decisions, but we also have the capabilities of handling the I dotting and T crossing with the IRS, as I like to call it. So with that, again, thank you everybody for your participation. Thank our panelists for participating, and everybody have a wonderful day, and please stay safe.